Good evening, everybody, and welcome to the December 2014 Roundtable, the last roundtable of the 2014 calendar year. Mid-Michigan Chapter is proud to present this program to our members and to the Better Investing members throughout the country. Tonight we have a full complement of knights. I'm joined by my good friend Mark Robertson. Also, Cy Lynch from the Atlanta area is with us this evening. Hugh McManus from out in the Pasadena area is with us. And in addition, we have a guest damsel with us, Kim Butcher. And Kim is from, let's get it right tonight, okay, Kim? It's Evansville, Indiana. Did I do that correctly this time, Kim?
You did. Thank you.
All right. So without further ado, I'm going to turn it over to Mark, and he'll lead us through the first 5 or 6 slides. Go, Mark.
All right. Well, thanks a lot, Ken. And again, we've been doing this for about 4.5 years now. We hope we're delivering value and ideas and things to everybody. We want to welcome the returning attendees, but we also want to give an extra big warm welcome to those of you who may be joining us for the first time. We do have a chock full. I mean, the Christmas tree, the presents are just stacked under the Christmas tree, so we got to roll and get through some of the stock ideas and some of the ideas that we want to share here tonight. First, of course, we do have to go through the official stuff. Everything that we do here is for education and demonstration. We do a whole bunch of this kind of stuff where we literally are trying to demonstrate and put to use the philosophies and the methods of the modern investment club movement, known as NEIC or Better Investing, as interpreted by Manifest Investing. But again, we're going to be talking about real companies in real time, doing case studies and that sort of thing, but everything's demonstration. No investment recommendation whatsoever is intended. If you want to be placed, or if you know someone out there who would like to be placed on a reminder list for future sessions, Natalie Kavula's email is down there, nkavula1@comcast.net. And then I'm also available for questions at markr@manifestinvesting.com. Ken, we are getting a little noise, I think, from your microphone, so you might want to adjust that. Here's our standing agenda. Again, if you're new to us, we generally follow this type of a format. We'll take a look at a reminder as to what we're trying to do here. We'll take a look at some results. We're going to kind of huddle around the campfire or the bonfire a little bit and talk about gifts that we may all wish for or may have received this year. There really isn't a challenge, and we'll have Ken cover that when we look at the portfolio. We probably will do some house cleaning or spring cleaning during the first few months of 2015, but nothing's really jumping off the stove at this point. Then we'll go into the stock presentations. Google by Ken, Liberty Broadband by Kim, BP again by Hugh. He seems to like to swim in that oil. Copa Holdings, I'm going to actually double down on one of Ken Kavula's recent selections. And Cy Lynch is going to insist on being stubborn with Cognizant Technology, one of the leading and actually quite well-performing stocks that going back over the last 4.5 years. And we'll close with an audience poll where the audience gets to select their favorites from the stocks that are presented. Just a quick reminder what we're trying to do here. We do come with what we think are potentially actionable ideas. Again, do your own homework. We're not recommending anything, but we do think that these offer some notion of potential. And again, do your own homework. We do keep track of the overall portfolio. We would really like to achieve a tracking portfolio that beats the market by 5 percentage points. That's 500 basis points. We do track versus the Wilshire 5000. We'd also like to see over half of our selections actually outperform a mirroring investment in the Wilshire 5000. And we're not doing too bad. A little bit of room for improvement on both of those, but trucking along actually pretty nicely. Here's a quick look at the overall results going back almost 4.5 years now. What this basically says is that we are slightly above a relative return of 0. And let's, again, define relative return. Relative return is simply taking the actual results achieved, the rate of return for the portfolio, and subtracting or comparing that to the Wilshire 5000. So anything above 0 means we're beating the market. And you can see we had kind of a slow start, some nagging selections that didn't do well in the first couple of years, but the overall trend's pretty good. We are headed towards that gift box on the right. One of the things that we like to highlight is that long-term philosophy of investment clubs aiming for a return of 15% over the long term. That 15% really does just represent a 5 percentage point advantage to the overall stock market, which over the decades, over many decades, has returned approximately 10%. So again, we're trying to beat the market over the very long term by 5 percentage points. We'd be happy with anything between 0 and 5. Obviously more happy the closer we can get to 5 or above. But that is the overall objective. When we bring the stocks here as ideas, we really are hoping that they're aimed in at the right trajectory here and helping us to achieve that goal. The outperformance accuracy, again, that's basically looking at every selection ever made in the last 4.5 years and comparing whether it would have beaten the market. And to date, nearly 50%, 47.5% of the selections that we've made have actually beaten the market. That's less important than than having a positive relative return in general, or from our perspective. Any questions or comments at this point, Ken?
No, we're clear, Mark, so you can keep moving.
Okay. Let's take a real quick look at the tracking portfolio. Again, you can find this tracking portfolio online. You can find the dashboard so you can view it. These are the top 20 stocks. I believe there's about 93 positions or stocks that have been selected over the last few years. These are the top 20 by percent of assets or asset value, starting with our largest holding, Cognizant Technology. And you can see we've actually superimposed a 10 in parentheses there. The 10 refers to the number of times it's been chosen. Every time a stock is chosen by either one of the knights, a guest damsel or guest knight, or the audience, we will invest $1,000 into it. So, for example, Cognizant's been selected by mostly Cy, but many of us over 10 times. So $10,000 has been invested into Cognizant Technology. It's now worth $14,600. So, fairly decent performance. And you can go right down the list and see some of the others. One of our favorites to point out is this PRA group. That was selected by Ken Kavula, and guest damsel Ann Manning. It's only been selected twice. So $2,000 invested has become almost $5,200 with PRA. That's the old portfolio recovery. They renamed it PRA Group. So,
Mark, I'm going to interrupt you and unmute Carol Fine. She has a question.
Mm-hmm.
Carol, go ahead. Carol, you're still muted on your side. Oh, she says no question. Okay, Carol, I'm going to take your hand down there.
She's tinkering. That's good, though. No problem. So, again, from top to bottom, any comments from any of the knights or anybody about the list? I mean, these are the ones that have been picked. Some of these actually look kind of compelling right now, in my opinion. BioReference Labs goes all the way back to day one. I believe that was selected in July 2009 or whenever that was, when we first started for the first time. And the only other one that really leaps off the page at me, Apple, has been really good to us here over the last couple of years. Didn't lose you, did I, Ken?
No, I'm looking at the $2,000 in ResMed that's doubled itself. I seem to remember that was a very early on pick.
Mm-hmm.
I believe that was one of yours, I think, Ken, and I think I doubled it down a year or so later. I think I picked that one once. But I know it wasn't my idea. I think it was yours.
In Bank of America, I'll stick up for Hugh. A lot of times people will pick on Hugh because of his rather untraditional or unconventional picks sometimes, including Bank of America. And he won't say, I told you so, so I'll help him a little bit. As you look at there, I mean, it was selected 4 times when it was, do you remember the days when everybody absolutely loathed the banks and just hated them? It's been selected 4 times, so $4,000 in Bank of America is now $7,400. That's nothing to sneeze at, gang. And one of the reasons that he ranks at the top of the all-time charts over the years.
Yeah, that's a good example of patience. Another one, just a couple of notches up, languished for a while and has finally started performing pretty well. That being Cisco is another one. patience paid off some.
Yeah, I've been visiting clubs, and they've been telling me that Fossil just sits there and doesn't do anything, but $4,000 has turned into $6,500, and a lot of companies go through periods where their stock price stays relatively stable as their revenues or their sales go up. So Fossil, and for that matter Aflac, are two companies that have done really well for us, even though right now their price seems to be kind of stuck in a rut.
Mm. Yeah, I'm fortunate just because of the way I buy things that most of what I bought for Aflac personally I would have bought many years ago, so the cost basis for that thing is really low. Because I like to look for things that are at 52-week lows, and that's it's a tough hurdle for a growth stock because price that just keeps growing. And the other one there that I'd start to get concerned about would be Staples, simply because it's performing very well at this point for reasons that might include the company getting totally acquired, but we will see about that. But it's something that for the future we might start thinking about selling, because the future growth for this company is kind of stunted a little bit.
And that could be part of our spring cleaning. I mean, you actually have a gain there now, and it's been kind of turbulent.
Nice, 45-50% gain almost.
Yeah, and again, many people are skeptical about some of the selections, but and in fact, some of you expressed some frustration or impatience with with us not selling very often. And we really do like to give stocks a lot of latitude if they're carefully chosen, unless there's a dramatic change in the fundamentals or something, or one of my completely insane picks that probably shouldn't have been picked in the first place. But we generally are going to give them a lot of latitude. All right,
Mark, we have a couple of people that are trying to figure out the relationship between the par column, that's the column on the far right for those of you that are looking at your screens, and the perceived appreciation to this value. They're wondering why the two don't match. Could you give us about 2 minutes on why they wouldn't match, Mark?
Okay, well, if I'm hearing the question right, they're talking about the stock price or the value of the company being elevated along with a forecast that's elevated. I may not be getting the question completely right, Ken. Can you clarify it all?
Yeah, I think some people are reading this chart and they're saying,
is it growth in par?
If the par for Cognizant is 20%, does that mean that there's been 20% since you bought it? And they're really not related to each other at all. One is looking to the future and one is looking to the past.
Yeah, let's spend just a minute on it then. At Cognizant, $10,000 invested has now become $14,600. That means it's gone up. And again, we're talking about multiple selections over a 4-year period have gone up 46%. So, almost 50%. Now that's where it's been. When you go out to that column on the far right, what you are looking at is the return forecast, the projected annual return. Now, at Manifest Investing, that's a consensus forecast based on sources like Value Line, Morningstar, Standard & Poor's, the analyst consensus estimates themselves, and just our model for taking a look. So it's as if you put all the analysts in the world into a room, gave them stock selection guides or stock studies, and asked them to come out with a consensus result. Their outlook for Cognizant Technology is a 20% return forecast. And that actually probably leads us into the next segue, Ken. The averages line is on this slide. Why wouldn't we be in a rush to sell a company from the list of 92? They're not all shown here, but you might take the group through the report card a little bit here, Ken.
Sure, I'd be glad to. If you want to move to that slide, Mark.
Well, I'm just talking about down here at the bottom, the averages at the bottom.
Oh, okay. Are those the averages for the entire portfolio?
Yes, they are.
Okay, well, these numbers at the bottom are basically telling us about all 90 some odd stocks that we're holding in this particular portfolio. We would never recommend that anybody out there, even with $250,000, hold 90 stocks in a portfolio, but a lot of times we're looking for ideas to give to you So we're adding a single stock just to draw a name to your attention and then kind of follow where it's going. We're looking to keep these numbers within certain ranges. We're looking to keep par, for example, in what we call the sweet spot. The sweet spot is 5 to 10 percentage points above what the average stock is anticipated to return in the next 5 years. I don't know, par, my par number is probably 6 something tonight, Mark?
6%.
6% even. So when you add 5 points to the 6%, you get 11%. So that's the bottom of the sweet spot. The top of the sweet spot would be beating the market by 10 points. That's up to about 16. Those 5 stocks on the list, or 4 stocks on the list with gold backgrounds, those are stocks that are above the sweet spot, and they might be getting a little bit rich. Frankly, they're hovering, all of them, fairly near the top of that sweet spot, and I think those returns might actually be fairly believable for those 4 companies with the gold background. But if those numbers should reach 40 or 50 or something like that, we might be looking for a group of analysts that have become a little bit too exuberant about their thoughts about a particular company. We like to keep the quality in the top quintile, the top 20th percentile, so we like to keep it above 80 if we can. The clubs that I'm in, we like to keep EPS stability above 80 as well, and our EPS stability is very respectable at 76 because occasionally we do look at companies like Bank of America where they have very little earnings stability for the past history. Bank of America with earnings stability of only 24 is going to drag that average down, and yet we had good reasons for adding it to the portfolio. We like to keep financial strength at 80 or above, and that's where it is, right on 80. And again, you'll notice in that financial strength column, we very rarely look at a company that's below 60 in financial strength, although occasionally we'll dabble our toe in the water with a Staples or with a company like PRA Group that have financial strength numbers a little bit lower than sometimes we normally look at. I'm looking over at the growth. One of our questions was, what does that growth mean? Well, that's a growth number for the next 5 years. It's an anticipated growth judgment. It's exactly the same kind of growth judgment you make on a stock selection guide. So we're trying to decide what the company will grow at for the next 5 years. We'd like to keep that number up around 11.5, 12, somewhere in that area. It's a little bit low for my tastes right now, and I think that's reflective of the fact that our return is a little bit lower than I'd like it to be right now as well. I would love to move this number up just to maybe 1 percentage point if it's at all possible to do so, but it'll be tough to move a large portfolio up significantly when we're only adding $5,000 a month to what's going on, and when we're not doing a lot of freezing. When we sell out of this portfolio, Mark will have to answer this question that I'm going to raise. Mark, when we sell or when we freeze a holding out of this portfolio, does that cancel the growth out of the growth number then?
Yeah, if it's removed from the portfolio, for example, if we were to spring clean a little bit and get rid of Staples, getting rid of that relatively flat growth forecast for that company would raise this number down here. So it does cancel it out.
Okay, so what we might be doing in the first quarter of the year is, since that's one of the numbers that needs a little bit of boosting, we might be looking at some of the slower growers and see if we have good reason to move them out of the portfolio. I know that Staples has been doing fairly well recently. I heard Hugh say that, and I've heard it on the news as well. So maybe we want to freeze some of those good holdings while they're still good holdings and take them out of the portfolio. I see a couple of lower numbers in this top set of holdings there, Cisco and and Teva are two others that we might take a look at. Intel's another one we might take a look at.
So just to kind of summarize, what Ken has basically said here is when we think of portfolio decisions, including selling decisions, we try to look at from the context of the entire puzzle or the entire portfolio, and basically the core characteristics of this portfolio are quite strong. They can be gently, or like one of Ken's favorite words, nuance. With a little nuance, we could do some slight improvements, but there's no major needs here. So we'll.
Right there, I don't see anything we have to work on immediately. That growth number does begin to trouble me just a little bit, but it's still healthy. It's just not as healthy as I'd like to see it. We have a couple of folks asking where they would find this particular dashboard. You can find the entire dashboard of Roundtable stocks by going to the home page of Manifest Investing, and over on the right-hand side you'll see dashboards, public dashboards listed, and I think the Roundtable is right in that first page list. Just click on it and you'll see the entire slate of Roundtable stocks and how they're doing at that particular moment.
Yeah, I usually have the link on here, but the link would literally be manifestinvesting.com/dashboards/public/round-table. So I'll show that a little bit later. Usually that's on the slide. For some reason I left it off this month, but we'll put it in the notes and stuff. Let's go ahead and keep rolling. I just thought I would share, and again, celebrating the gifts that we have received this year. Some of the stocks, just to give you a feel for how we track some of this stuff. These are stocks that have been chosen within the last month, or excuse me, the last year, top to bottom. The ones that have performed the best versus the market are at the top. These have all outperformed the market. That's not all of our selections have, but these are some of the stronger performers. See, Susan Michelik's Caesar Stone's actually doing very well since September. We've done quite well. I kind of like the fact that the name Robertson is on here in several places this year. That doesn't always happen. But many of our guest nights are on here, and I'd also like to point out that a whole bunch of audience selections make this list. So we all should fare pretty well when we take a look at our snapshot of annual performance and all-time performance come February. So let's keep pressing on. We do have a kind of a tight schedule tonight. What I thought we might do for the next few minutes, maybe take 10 or 15 minutes and talk about some suggestions of gifts that we might find under the tree. We'll try to keep these quick. Kim's going to share some thoughts on secfilings.com. I want to talk just briefly about Body Central and what I learned on debt this year. Sai's going to include his in his Cognizant report, and Ken and Hugh might chime in with some along the way too. But Kim, go ahead and share what you have discovered here.
Well, I know that sometimes I go to the SEC website and I'm looking for I'm looking at some of the filings for the quarterlies and the annuals and all, and then you look at the 4s and the 8s and all. Well, I found this website, and it is just a lifesaver. You sign into secfilings.com. You put a list of stocks that you want to follow, and every SEC filings that a company will file will just get pushed into your inbox. Now, granted, it can be kind of overwhelming, but it's really nice to see as to what insiders are getting special options, how many shares have they bought, are they aligned with shareholders, or maybe you're finding out that the executive compensation is being changed and it's not based on financial metrics, it's being based on something totally different, which is not very shareholder friendly. So I found this website to be beneficial to me, to be able to keep an eye on my stocks in my portfolio, because anything that a company has to file with the SEC automatically gets pushed to you. So I really don't have to listen to any of the noise of the market and read about what's going on. I just read what's actually happening within the company to judge if I should have this stock in my portfolio.
Sounds like a good one. Now, it says free account. Is that everything's free here?
You got it. I like free.
free works.
Free works.
Sounds like, a lot of you guys out there in the audience are avid foaming at the mouth type investors. This sounds like a pretty good idea to try on some of your portfolio holdings for sure. Thanks, Kim.
You can always set up a new email address, Gmail or something, to get these filings. That's what I do for SEC filings. That way it's not as cluttered, and you can skim through it very quickly because you're only going to be looking at filing-related documents and decide what you want to keep for yourself. What you actually want to read.
That's an excellent idea because I do sometimes get overwhelmed with the number of SEC filings that I get, but for me, if I had to sign into more than one account, I'd probably not get to the other account.
Yeah. I look at them for all the biotech companies, and so you get overwhelmed with 8Ks, so you have to filter those out, et cetera, and then just look at the important ones. And the older I get, the more the documents you really need to look at are the 10Q and the 10K. I mean, those things are gold.
You serious investors. Good stuff. All right, I thought I'd spend just a moment here, maybe in a batch of crow pie. Some of you are very familiar with this, but going back a little over a year ago, I became slightly infatuated with a company by the name of Body Central. In fact, the ticker symbol, I'm not sure it's still the ticker symbol, and that's a really bad sign, but BODY. And I basically went through the analysis that it had a tremendous drop in stock price and, still had a decent financial strength and all that kind of stuff that you can talk yourself into. And then I pointed out that the company had no debt. So in my theory, in fact, I've been teaching classes like this for 20 years, the absence of debt basically removes a lot of the threat of bankruptcy, at least hypothetically. And that makes sense to me. In general, that's still true. But I learned a very powerful lesson with Body Central. They didn't have any debt, but when they needed money in the middle of last year and went out to the banks and tried to get some, banks were willing to give that to them while they were still, drawing a breath, but they were charging them like 16 or 18 or 19% interest on the loans. It's basically junk debt. So they basically went very quickly from a situation where they had no debt, which to many of us is very attractive. But what I would point out is that, that situation can turn pretty quickly for a company like. Now, many of you are sitting out there saying, "Well, I told you, Mark. I told you were in danger." All that stuff. I basically was going by that fact that no debt meant that they were probably not going to get into trouble. And again, that can change when the company needs money. I learned very quickly that the type of debt that they took on was probably fatal to that company, and it's just something to think about because it's one of the beginning points that we teach, in the investment clubs and in the community, and you have to keep a real strong eye. Even if a company has no debt, take a look at their needs for cash versus their balance sheet, and hopefully I won't make that mistake again. I made that one with real dollars, so. Something that you might want to keep in the back of your mind. Any comments, or you guys want to rub any salt in my wounds, or revel in the moment? Feel free.
Mark, all I can say is I've done it too, and the best lesson of all is when we learn with our own money.
Yeah, it's less.
I had to learn in a retirement account.
Yep.
Hey, Mark, have you ever seen one of these Body Central stores?
Yes, I have.
You have. Did Wendy let you actually walk into it?
No, it wasn't real impressive. I will say that. I stopped at the door. Didn't really do much with it, but.
Yeah, it kind of reminds me of Frederick's of Hollywood store.
Oh, well, now I'm more interested.
Yes, you really should be. I would really like you to go and check one of these out sometime. Natalie and I walked past one, and I walked in and was pulled right back out again. So,
well, you live, you learn.
Very interesting retailer, Mark.
Yeah, cool. All right, well, Cy's going to cover his instant industry study as one of his gifts. Hugh and Ken, if you want to chime in now, if you want to come back later at any time, any thoughts at the moment?
Let's go to Cy.
Okay, we're gonna start with you. So you're first on
all right.
Google. So
okay,
Google
well,
first up.
My Christmas gift is just a reminder to everybody to occasionally go back to your library site, your local public library site. I'm constantly amazed every time I go back to my own public library, my local library, about how many different things there are available for me to use, how many different tools there are. There's always seems to be new sources, new places to visit. And right now, at least at my library, I can get Morningstar and Value Line for free. I can do all kinds of reading of newspapers throughout the country and business journals throughout the country. And I just find it a wealth of great information, especially when I'm doing initial research on a particular stock. Mark, are you going to go to my slides? I don't have very many of them.
I will. I was going to add libraries here.
All right.
So we'll just say discover your library.
That's great. And I think many of us just forget that this place is no longer a big dusty building that houses books. It has so many electronic resources that are available to you right from your tablet or your smartphone or your computer. And if you haven't been there in the last 6 months, make an effort to go see what's new. Yeah, or 6 years. Yeah. Make an effort to go see what's new. Yeah.
And not to belabor the point, Kim, but keep an eye on what your broker offers as well, because that does change. I noticed Schwab has added Morningstar. So
absolutely.
Morningstar stock studies. They've had Morningstar Mutual Fund.
Yeah, absolutely. Sometimes things that I really like to see have disappeared as well. I'm having a hard time right now finding S&P resources to get good old standard S&P reports. So I'm going to have to maybe open a new brokerage account to come up with that information. But you're right, Si. The broker has a lot of resources, and many times they have new platforms that are interesting to look at and might even give you a leg up on some ideas for investment as well.
And that actually prompts a thought. We'll get launched here in a second, but let's give Hugh a chance to chime in. Hugh, does Merrill Lynch have Standard & Poor's research? Would you like to make any comments about Merrill Edge?
Yeah, I mean, I switched to Merrill Edge, as you know, about a year and a half ago. And part of the drive for that were comments that I read from folks in Manifest Investing. It's a wonderful site, wonderful broker, for one simple reason, that the transactions are free. And when I joined, you needed to have a balance of $50,000, I believe, and you got 30 free transactions a month. They've now lowered that to $25,000, and it doesn't work in an IRA account, FYI, but a regular brokerage account. Dividends aren't reinvested, but that's fine. When you get 30 trades a month, you can handle that in other ways. But the other interesting thing is they tiered the account as well, which I didn't realize until Ted Brooks made the comment about the balance, and I went and checked the website and discovered, ooh, now I get 100 free trades a month. And I was finding it very challenging to get even close to using half of the 30 free trades. But yeah, Merrill Edge is for our type of people, long-term investors who want to be there for a long time. It's a great site, and it does have a lot of research material. I pull the S&P data actually from TD Ameritrade because I have an account there as well.
Okay. And
I've been using that one for a long time, so that's where I get my S&P from.
Well, we have all kinds of folks telling me that Scottrade offers S&P reports. Yeah. I have a Scottrade account, and yet I have a hard time finding the S&P reports. I guess I'll have to go back and look again.
And the one thing I just want to let people know, because there's a lot of new people here, that TD Ameritrade charges, what is it, $9.99 for a trade?
Yes.
But it is negotiable. So I'm currently down at $7. I just asked them to lower it, and they do. And they lower it in all accounts, from regular brokerage account through all types of IRAs. I'm sure I know some people joined TD Ameritrade through, and I cannot remember the name of that company for the life of me, but it'll come back to me. And those people are actually getting $5 trades, I believe. But if you're out there and you have TD Ameritrade or any other account, you can always ask them to lower it. I've discovered Schwab is not that open to negotiation, nor is Merrill Edge, but where do you go from zero?
Yeah.
But certainly TD Ameritrade is.
Well, those are all good gifts, guys, and we'll probably be sharing more on the forum about some of those going forward. So thank you. All right, Ken, take it away.
Here we are. I will. Here we are looking at Google. This is not exactly the same graph that you get when you bring data into your toolkit, for example. Remember that Manifest Investing likes to incorporate the next 2 years. So we're looking at 2 years of analyst estimates for this company, 2014, 2015, as well as 8 years of history. So it's an interesting way to do a stock selection guide. I happen to think it's a entirely upfront way to think about what a stock is going to do, and where the analyst community, which represents so much of the market today, where it's going to take the stock, whether we like it or not. I like to see that the growth is appearing to be relatively steady, relatively consistent, nice relative straight lines there, and it's certainly a stock that I would want to consider if you click the slide. So I go to the web page, and this company is not afraid of telling us its mission right up front. There it is in big black letters on under what we believe. And if you drill down a little bit into this what we believe page, you'll see that actually this mission is broken down into 10 extremely simple, easy to understand statements. And the company is really serious about following through on those 10 statements. Google would like to be ubiquitous. Google would like to involve itself in everything that the world has to offer, and it would like to be part of what everybody experiences when they do anything with the web. So they're well on their way for a company that's only been listed on the public exchanges for 10 years. The company certainly has become something that has entered the vocabulary of mankind and has become something that we all kind of take for granted. When you Google something today, it's just as bad as when you grab a Kleenex or when you look for Jell-O. Those things have become commoditized, and Google is a verb now to stand for almost any kind of web search that you'd like to deal with. If you click again, Mark. Google operates in 3 business segments. Google Websites, which is a huge part of their business that they operate directly. Network websites, where they handle search products for other companies. And then things they call other, which are unique businesses. Most of you might know that Google owns YouTube, and YouTube is part of that number 1 as part of the Google Websites business segment. More than 80% of their revenue comes from Internet search, and that's also by far the highest margined product that Google has in its arsenal of products. If you click again, Mark. They handle 60% of worldwide search. Now that number has come down a little bit in the last 5 years, but when you compare it to the fact that no other competitor comes even up to the 10% level as far as market share is concerned, you can see that Google has a huge advantage when it comes to the people dealing with search engines. And what research has shown is that if you tend to deal with a particular search engine, you tend to be kind of sticky with it, which means that if you get to know its peculiarities, you tend to use it on a consistent basis. Remember that there are 500 million Android devices out there, and all of them use Google products to deal with search, which leads us to the number of 90% of all mobile searches are performed using Google. Mobile searching is the fastest growing segment of web searching that's being done, and again, 90% of them using Google products. Google invests heavily in research and development. Google could easily add 10 points to its margins if it were to severely cut back R&D, but they've made it quite clear that they don't plan on doing that. They're going to keep researching and developing and adding new products and new twists to the products they already have because they wish to, again, become, and this word is all over their website, they wish to become ubiquitous. 55% of Google's business is international. You can see the location of all of their offices by the Google Maps symbol, that little red circle with the pointer on it, and you can see that they have a preponderance of offices in Europe and Asia, as well as a large number in the Western Hemisphere. But again, 55% of Google's business is international. It's not North America based. If you click again, Mark. I took some screenshots from Value Line. Value Line likes to give us projections for the high and low price 5 years from now. They like to annualize that, and we've found in Manifest Investing that the low price projection should come very close many times to matching a well-prepared stock selection guide. And right now, in the most current Value Line report that's out there, Value Line is suggesting 15% annualized return at the low end. The rates box suggests that revenues are growing just shy of 15% and that earnings might be growing as high as 18%. Pretty hefty numbers for a company this size. Morningstar is not quite as optimistic as Value Line. Under their valuation paragraph, I grabbed the sentence there that Morningstar forecasts revenues to grow by more than 12% annually during the next 5 years. So I get that more than 12%. So, you know, I'm kind of bracketed in the 12 to 15% growth rate for revenues, maybe even 12 to 16% when I read some other sources. But I'm pretty confident about the growth of this company going forward. Next slide, please. Here I am looking at an eagle. This is the default eagle on Google. Remember, Eagle is an equity analysis guide for Manifest Investing. The arithmetic matches exactly the same arithmetic that we're doing on a stock selection guide. We start with a stock priced at $537. That was a day ago. A current PE ratio of 28.3. And earnings in the trailing 12 months of $19. Earnings per share, trailing 12 months of $19. Share count of 676 million shares. And net margins in the last 12 months of about 19.4%. Sales in the trailing 12 months of $66,129 million. And my first judgment comes then with what do I think sales will grow at. It's the same as the first judgment on the SSG, and I've decided, or Manifest default number is 15%. I certainly think that's in line with some of the sources I've read. So you grow the $66 billion by 15%, you get the $133 billion. You decide on net margins going forward. Everything I read indicates that Google's margins are on the upswing. That 19.4 was a little bit of a margin challenged by some one-time charges. 24.1 is much closer to where the margins have been, and I'm going to keep it right there for default. Shares have been rising, so 5 years from now I'm estimating about 700 million shares. Earnings, I'm predicting, are going to be at $45.96, and that's by doing a preferred procedure and using a PE value, times a number then to get a stock price. So there's my earnings number, there's my PE value, and that gives me an $1,100 stock price, which I can retrofit then to find out it's a 15.5% gain from today's price. There's no dividend, so that 15.5 par value stays. That's a pretty fast run-through of the calculation, but I want to assure you that it's the same calculation that's being used on the stock selection guide. Another click, Mark. I just like to pull up this this chart just to show you what Google is doing. I like to see a quality line. That's the blue line that's consistent, and this quality certainly has been extremely consistent, staying between 90 and 100 now for the last 3 or 4 years. I like to see a par value that's higher than it's been recently, and I'm certainly looking at a par today that's higher than maybe it's been in the last year, year and a half. In fact, I think I have to go all the way back to 2012 to find a par value that's as high. I think Google has the potential right now to give me a positive relative return. I love to have stocks like this in my portfolio. I would consider Google to be a core holding, and I would consider that if I'm going to buy this stock, I'm probably going to hold on to it for a considerable period of time. I think that this might be an opportune buying period at this particular point, so I'll suggest we add Google to the portfolio.
Okay, thanks, Ken. One thing that I will point out is these numbers here need to be fixed. That's missing a stock split, so you need to divide every single one of them by 2. Basically move them down here. So that's something we have to fix at Manifest. I wasn't aware that even looked like that. The things you learn. One thing I also will point out is we featured Google in our August cover story. And for those of you that don't know, for its first 10 years since its initial public offering, it returned 28%, 28, that's 28 per year. And that's pretty spectacular. This thing's a monster, and I'm happy to see it included in the tracking portfolio, frankly. Any other comments, Ken?
No, there's a lot of things in the question box, and I'll read through them and see if I can answer some of them, okay?
Okay, we'll come back to your Q&A. So for now, let's go ahead and switch gears and bring Kim. I like Kim as a very successful stock picker. She's got a little bit different outlook, and I think Hugh needed some company on the unconventional box, so Kim is here to give Hugh some company. And take it away, Kim.
Oh, well, I always like to be a little different. Last month we talked about Liberty Media, and Liberty Media is actually a holding company, and within it, it's kind of like a Berkshire Hathaway underneath the title Liberty Media. They have stocks underneath it, and one of them, I don't know if you know this, they own the Atlanta Braves. Also, they own Sirius Radio.
He's
Yes, and Sirius Radio is kind of interesting because they gave Sirius Radio a loan, and as a result, and to pay it off, they ended up with 40% of the company, and then they've been buying back more shares. So they actually, because of Sirius Radio, get $1 billion worth of cash a year out of them. So they just spun off this stock, Liberty Broadband, as this says here, on December the 4th, with a 1-for-4 split from a spinoff. So it was tax-free because, as I talked about last month, John Malone has been in the cable industry for 30-plus years, 30, 40 years, and he believes in avoiding paying taxes at all costs. And so he is the one who developed spinoff stocks, and this is a spinoff stock. Now, they spun this stock off on December the 4th for a price of $47.08. Now, a lot of people may not realize it, but they have ABC shares. A shares is 1 vote for 1 share. B is 1 share, you get 10 votes. And you can't have a C on the end of a stock, so it's K instead. It's 1 share and no votes. And you might wonder, why do you even buy a stock and you have no voting rights? And I'll get to that here in a little bit. But one of the other things that they did in their spinoff is Liberty Broadband, when they spun off, hypothetically, you started with 100 shares of Liberty Media. If it's 1 for 4, so you ended up with 25 shares of Liberty Broadband given to you free in your portfolio. And then they also have a rights offering that began, that for every 5 shares you could have the right to purchase more shares at a 20% discount of the last 20 trading days. Well, these rights offering began trading on the stock market on December the 10th, and ironically, the 20-day trading window lets the price of the stock, if you choose to have the right subscription, of $40.36, because on average the stock has been selling between 50 and 54 bucks. So this is a play on a spinoff, and also on that book I talked about last month of You Can Be a Stock Market Genius. Next slide. Liberty Broadband consists of Charter Communications and True Position with an equity investment in Time Warner Cable. They are the 4th largest cable operator in the U.S. So this is a play on the cable industry, and if I asked, and we had a poll right here, I'd say, who does not have cable within their home? And that's one of those recurring revenue things that we keep having to pay the bill every month to have cable. So this is one of the reasons that this stock was interesting to me. Next slide. Now, this is a picture of John Malone. In that book, actually it wasn't in the book The Outsiders, which was a book that Warren Buffett had recommended to read at the annual meeting last year, and I bought the book this year at the annual meeting. There was a chapter on him on how he was such a great capital allocator for his company and how great returns he got because he used tax-free spinoffs, which protected the shareholder from having to pay capital gains. He used debt. He used other forms of leverage. He had swap outs. So he was the most creative and also giving the greatest returns to shareholders. And if you were at last month's roundtable, we talked about quality and good management, and he is an excellent capital allocator. And in the other book that I mentioned, You Can Be a Stock Market Genius, there was a whole chapter on John Malone and how he took the company TCI way back when, and ultimately it went into Liberty Media. And this chapter started with, how do you make $500 million in less than 2 years? Ask John Malone, because he started with $50 million. Next slide. That's the kind of asset management I would like if I have someone who's the CEO and manager of the company that I own. This slide was in the Outsiders in the book on that chapter, and this stock actually even outdid what you had said, Ken. The total shareholder return exceeded the S&P on the stock that John Malone followed of TCI, had a 30.3% compounded return yearly in the time frame, average in time frame from 1973 to 1997 until they combined in with Liberty Media. So I'm just kind of showing here that you got great capital allocator here. Next slide. Okay, as I said, this is about the book was recommended at the annual meeting, and how John Malone, what it talked about in there, that he likes the cable industry because it's highly predictable, it's got a utility-like revenues, favorable tax characteristics, and right now data usage is growing like a weed. So when we first started using a cell phone, we just called and talked to people, and now your cell phone bill is based on how much data you use. What John Berlone has proposed in different meetings that I have listened to on the internet in presentations was he believes that ultimately the cable industry will consolidate, and whoever has the most content, who can do and keep costs down, is going to be the one who's going to survive the best. Next slide. In November, Liberty Broadband had a PowerPoint presentation, an Analyst Day, and these are a couple of slides from there. As you can see, Charter Communications is underneath Liberty Broadband, as I said, and they own about, right now I think it's about 33% of the company. They believe that Charter Communications got a great management team. They've got a lot of cash on the books. They've got that tax-free spin-off of Liberty Broadband that I'm talking about. And they did exercise the charter warrants in November, and they got a great return on that because they had those warrants. So it's just another way of showing how well that the company does with their management. Next slide. Now the other thing is with their management team, they're great at M&A, and so I believe what's going to be happening in the cable industry is, my theory is that you're going to have a lot of acquisitions and consolidation, and if what's going to happen here is John Malone currently owns like 47% of this company, and if he's going to be the chairman of the board of this Liberty Broadband, and he can help guide and help with these acquisitions because Charter Communications can be able to do it, and Charter Communications being underneath Liberty Broadband, I feel that I'm going to end up having great growth. There's lots of other information on here. It drives cash flow, which is always good. They're well positioned to lead future consolidation within the industry. That's the whole thing I talked about. They've got no overlap with Google Fiber, no overlap with Verizon, and they do have investments and part of the Comcast deal also. Next slide. When you always worry about their liquidity of how are they going to be able to do this, they have $67 million in cash right now with their Time Warner cable shares that they have the rights to. Then they have a loan capability of, and this is the thing that's really interesting, if those people who want the rights offering and they pay for that, they're going to projected to get $657 million. Well, I think those rights offerings are going to be able to let the company grow dramatically with getting those acquisitions going on. Next slide. This was the other book I was talking about, You Can Be a Stock Market Genius, and it's a little confusing about rights offerings. So on page 113 it says, a telltale sign of a bargain offering price is the inclusion of the oversubscription privileges in a rights offering, and it's prorated as to who is going to get the shares. So you have the 100 shares of Liberty Media, you've got the 25 shares of Liberty Broadband, and then you're going to be able to buy five more shares of Liberty Broadband at the prorated price of $40.36. And considering the stock is selling at like over $50 a share, that's not too bad. And the thing is you had to read all the SEC filings, and that's how SECfilings.com helped me, because you had to say you want the rights offering and the oversubscription privilege that you are capable of having at the same time. So if you would get those 5 shares in the rights offering, you can also get 5 more shares by telling your broker that you wanted the oversubscription. Next slide. I always think it's important to find out as whether or not the managers are incentivized along the same lines as shareholders. So do they have skin in the game like you do as a shareholder? Well, John Malone is to own 47% of the company because he's the chairman of Liberty Broadband, and we've shown how well he's been a great capital allocator in the past, and like a 30% return when he managed the other cable company before. Greg Mahaffey, who is the president, I found this from the SEC filings as of December the 16th. He owns the A shares of 22 million plus C shares of 44 million, so he has at least, add that together, fact, $67 million. So he's got quite a bit of skin in the game there. But this was the neat thing. They just announced, and this was like just December the 16th, that he will have the option to purchase 1.5 million more shares at a price of $48.10. But this is 50% are vested in 4 years, and the other 50% are vested in 5 years. So think about how much, $48.10 times 1.5 million shares is like $72 million. Charter Communications is selling like at $169 a share, and that is 1/3 of their assets in this company. So I keep thinking that this is going to be a great play, I believe. Next slide. Here it is, the options, and it talks about the anniversary date and fifth year anniversary. So he's got, in 5 years as BI members, we want our stocks to double. I have to admit, I'm kind of hoping for more than just the double here. If he can do like he did before when he took and ended up with, like he did before with TCI, and the chapter before is, like I said, of what did he have on the slide? How do you make $500 million in less than 2 years? Start with 50 million. If he could do that again, I'm not complaining. Next slide. In that same book, You Can Be a Stock Market Genius, it says, remember one simple concept: no matter how a transaction is structured, if you can figure out what's in it for the insiders, you will discover the most important keys in selecting the best spin-off opportunities. I personally am thinking that this is going to be a great spin-off opportunity because obviously you've got upper management, because with what John Malone is going to own, who is the chairman, and what Greg Mahaffey is going to own, that's going to be almost 70% of the outstanding shares. So they are incentivized quite well to do a great job with this. And that's my presentation.
Okay, well, thanks, Kim. Definitely, we're taught to pay a lot of attention to the management and how well they take care of the company. So you definitely focused us in on a pretty important aspect. Thanks. We'll go ahead and add that to the tracking portfolio. Let's go ahead and switch to Hugh and BP. We do have about 15 minutes of time left before we need to sign off, so we'll try to. I only need a couple of minutes, and Cy is doing a repeat on Cognizant, so we should still be in pretty good shape. Let's go ahead.
Yeah, I don't need. I don't need a lot of time on this either. Yeah. You can hear me okay, I'm hoping.
Mm-hmm.
Okay, so we move on to the next slide. I picked BP. I go through the same rigmarole every time. I track stocks. I look at the price. I download the range from high to low. For interest sake, I look at the dividend. But I wanted to see where it is, how close it is to its 52-week low if it's a large company, or a 5-year low if it's a small company. If you move on to the next slide, you can see it's almost like a ladder. You get the 52-week low at the bottom, and if it's at the 52-week low, it's 0%. If it's at the 52-week high, it's 100% of the way to the high. It's not close to the low at all, if you will. Move on to the next slide. I think it just shows you where I want to be. And so if I also look at the manifest investment quality rating, that's in the second to the last column, and the projected annual return. So you see the price. The where column just says how close it is. For example, PM Therapeutics, which we're not going to talk about, is 1.2% to its 1.2% of the way to its 52-week low. Caterpillar is 27% of the way there or thereabouts, and BP is close to 22%. So the next slide just shows the zone that I'm going to be in, and it's all about protecting downside. So as I said, I look for things that are close to a low. Quality companies that are on sale, and quality is the key element here. BP might be a little bit iffy, but I think if you thought about it, many people would argue that, yes, it's going through a rough patch right now, but they would expect this company to survive and exist for at least 20 years, 30 in the future. It could be acquired, but the company, in essence, would still be around. It's unlikely to go under. And then on the next slide, I just look at the companies that are near their highs that I take a look at, and Home Depot is within 0.9% of its 52-week high. Of course, its yield is low as a result. And on the next slide, you just add in the manifest investment measurements of quality and projected annual return, the last two columns on the right. These are companies that I don't look at necessarily because they are close to their highs. I like companies to be close to a low. And then we move on to the very next slide. Just reiterate again that I'm selecting BP to add to the portfolio. It was chosen last month. It is tied to the fate of crude oil, and I will talk about that in a jiffy. It's dealing with fallout from the Gulf spill of 3 years ago. It has exposure to Russia, which is a good and a bad thing. Not a good thing in the short term, but very good in the long term. It is suffering more than its peers, but it is a long-term play, and BP is something that when I buy it, I would hold for, I hope, multiple decades. And on the next slide, we just look at the stock selection guide, a bit of a mess. You can definitely see where the accident happened in the Gulf when you look at its earnings. It took a nosedive a number of years ago. But moving on to the next slide, we can look at the second part of the stock selection guide. This is what SSG stands for. It's a tool for trying to identify the quality and the price of a company and coming up with a method for selecting quality companies at a low price. And this slide just looks at some of the assumptions that were made. The projected revenue growth is 4.8%. I selected 4.5. Selected, as Mark talked about earlier, numbers for its pre-tax profit margin, its average tax rate, the likely number of shares outstanding in the future. That number has been declining, and I selected the default value for the future because it made sense to me when I looked at what the toolkit, which is the software that you use to produce stock selection guides, or at least one of the software options. And the anticipated low price is critical for determining whether the current price is in what would be called a buy, a hold, or a sell zone. And this anticipated future low price is based on the price the dividend will support. So I skip to the next slide. I can give a justification for why I'm being so conservative here. In the software toolkit that I talked about that I use for producing stock selection guides, it's a 2-page printed sheet, printed on both sides, but it provides much more information. You can download the information from Better Investing and fill in the judgments for yourself. And one of those judgments is selecting a low price. The forecasted low price comes from a low price earnings ratio. You could also select the average low price for the last 5 years, which gives you a number of $34 and change, or a recent severe market low price, which gives pretty much the same number. And then there are a number of different ways. Now, I very conservatively choose the price the dividend will support. It uses a model called the dividend discount model. I won't get into it here, but it gives a very low price of $24 and change, which actually keeps it out of the buy zone on the stock selection guide. And if you skip to the next slide, I'll say the reason is that I believe that BP, more than many other companies, but perhaps not more than companies in its space, like ExxonMobil, etc., is more of a dividend play. I think using the price the dividend will support gives a better estimate of where the share price could bottom out. And there are many reasons for that. When you read online about the company, you will discover that for BP, 1 out of every £7 paid into pension funds in Britain actually comes from dividends from BP. And there's probably 2 groups of shareholders, by and large, within BP. There are long-term holders who are using this company as a source of steady income, and there are short-term holders that want to trade the company or bolster their portfolio for the short term. Those people, this latter group that is short-term thinkers, would obviously bail when there's any bad news around a company and hurt the price for those that hold the company, but would be beneficial to those that want to buy it. The price would collapse. And that certainly has been what's happening. Collapse is a strong verb to use, but the prices of companies like ExxonMobil and BP and others in the group have been hurt by the recent problems in the oil sector, the fact that they there is oversupply, and as a result, the price of crude oil has been dropping. And I'll just touch on that briefly as we move on. And if we go to the next slide, we can look at the part 3 of the stock selection guide. The two pieces of information that I selected out of here really are the high and the low PE, price to earnings ratio, which is used to calculate a high price for the future. And conservatively, I've chosen 9.3 and 6.5. I think it's a fairly conservative number looking at what has happened to the company in the past. And if we skip along to part 4 of the stock selection guide, all of this information is put together. A high price earnings ratio, estimated earnings 5 years in the future to get a forecasted high price, and then I use my estimate of the low price, which is the price the dividend will support, to come up with a low price. And then you subtract the low price from the high price and divide it into 3 evenly segmented divisions, or divide it into 4 in this case, to come up with ranges. The bottom 25% of that range is a buy. The top 25 is where you might consider selling, or in probably better parlance among the better investing / NAIC community is where you would definitely not consider buying. You'd have to have a very strong reason. But in this analysis, it pushes it into the hold zone. But I do want to say that's driven all exclusively by the conservative choice of a low price, and most people probably wouldn't go that low. I'm going to buy it anyway, and I have been adding it to my portfolio, as those of you who follow or part of the manifest investing community would know from posts recently. And then moving on to the next slide, we can see what manifest investing says. It goes through a very similar approach, dividing the world into projected annual return and quality, and it comes up with a number of 13.5%. The quality for this company is low, but we can talk about that afterwards for those that are interested. But moving on, when you look at what Manifest says of 13.5 and you look at part 5 of the stock selection guide with my conservative analysis, right down at the bottom where you see D there, you can see that the projected average total return with the stock selection guide approach is essentially identical, 13.6%. That seems reasonable to me. And so if we move on, we can look at what the motley fools have to say about better investing, and of course, the majority believe that it will outperform its peers. I guess the time horizon here is 12 months. And we can see down below as well where we're looking at quality, which is not as stable as one would like, and certainly not very heartwarming, but the projected annual return has been rising recently, presumably because the stock price has been falling and nothing else really has changed. So we skip to the next slide. There are just 3 slides I just want to stress here, because there's a lot of clutter, I think, in the media about oil prices and the impact that it would have on consumers in the U.S. and stock prices in general. The fact of the matter is, when you look at the average fuel consumption for all vehicles, and I found the numbers up to 2004, but it doesn't change a lot to 2014, it is flat. It really hasn't changed a lot, and in fact, in the 90s it was rising slightly. Where it had the biggest impact, the biggest drop, was early in the 70s when there was the oil embargo and the oil crisis. That's when there was a major shift towards more fuel-efficient cars. I think there is going to be a downward slope because what they call the CAFE standard is being imposed and it's getting stricter, so I think you will see more fuel-efficient cars in the future. But there's not a major change going on here. The second point on the next slide shows energy consumption worldwide, which is growing. And this is from Wikipedia, but the original source, I believe, is from EIA, which is a government agency here in the U.S. But you can see that there's a steady increase over time from oil consumption, driven almost exclusively by emerging markets as they become more more capitalist, buying cars, etc. Certainly, oil has been increasing, coal has been increasing dramatically, and natural gas has been growing, whereas nuclear and renewable are growing but kind of more flat. But the next slide is really key, and this comes from the EIA as well, by the way. You can go on the website. I believe it's right on the splash page, and it looks at the imbalance between global supply and global demand of oil going back to the first quarter of 2009, right up to that dotted line, which is today. And right now, looking over in the left-hand column, the world consumes about 92 million barrels of crude oil per day. About half of that ends up as gasoline. Now, the prices plummeted fiercely because you can see a few quarters ago that we were producing more than we were consuming. But now we're right at a balance, and so those little green bars that you see further down show that we're out of whack by maybe 200,000 or 300,000 barrels a day. But there is a huge impact on gasoline prices. You don't have to go very, very far back in quarters to see that when there was undersupply in, say, late 2011, prices started to climb towards $4 and higher. Certainly in California, it got close to $5 a gallon in certain places. And it only takes about $1 million $1 million barrels a day out of whack for that huge jump in price, for it to jump 2 to 2.5 times. There is a huge effect on oil price when there is a slight imbalance in production of crude oil. And it's all got to do with the fact that it's highly capital intensive, it has a high break-even point. But the fact of the matter is that today more and more crude oil sources have been coming online, and that's not going to stop. Certainly if the price gets down where I think it'll go, probably close to $40 a barrel before things settle out, then it'll shoot right back up again. But I'm saying this because to me it gives just a wonderful opportunity to patient, long-term investors to buy companies in this crazy industry whose prices collapse once crude oil gets out of whack a little bit. And the reason I'm saying this is because of these short-term thinkers who are in the market who will dump these shares, and you don't seem to need a lot of them to dump the share for the share price to start to tank. And then they go on and buy other things. The supply-demand model from the stock market gets out of whack too. The price drops as a result to clear those shares that are being sold and sold aggressively. And so people like me and people like you who are patient, long-term investors who want an extraordinary return with a quality company will go in and pounce on the Exxon Mobils of the world, on the ConocoPhillips, the Phillips 66, etc., to buy companies at a tremendous discount. Now, your appetite for risk would determine whether you buy an Exxon Mobil, ConocoPhillips, versus what I'm doing here and adding more British BP to the portfolio. But I see more upside with BP. I do see rocky days ahead and rocky days continuing for the next year or two, but I'm holding things for the long haul, 10 plus years. So let's move on, I think, to the final slide. Oh, yes, and by the way, if you're a contrarian, this is a book that I've reading recently, The Moral Case for Fossil Fuels. I'm not taking a political stance one way or the other, but it's a very, very interesting read. It uses information that's readily available on a number of different government websites and produces a very interesting case. I'm just throwing it out here because I've enjoyed reading this book over the holidays. And so skipping along, crude oil is the ultimate commodity. Small imbalances in the production and consumption of oil result in huge swings in retail gas prices and consequently huge swings in the price of companies that serve those industries, BP being one of them. These low prices tend to be temporary, so I at least try to pounce when I can. Temporary is months, not years. But BP is a good company. It has problems, but it has also got strong cash flow and a lot of quality assets that it is exploiting around the world. But long term, I believe it is potentially a good buy. So with that, I will also say goodbye.
Okay. Well, thanks, Hugh. We'll go ahead and add BP to the pile one more time. All right, I'm going to go ahead and crank through these pretty quickly here. This is our Ivory Soap Screen, where we're basically screening for the best companies in terms of quality and projected return at manifest investing. So we're looking for the top 1/2 of 1 percentile in those two key characteristics, quality and projected annual return. Just kind of looking down the list, you see a number of companies, including Ken's nomination for tonight, other ones that have been around in other recent months and parts of the portfolio. You mentioned Fossil earlier. I'm going to go with Copa tonight. It's a company that Ken presented a couple of months ago at a roundtable, so you can go back and dig into. He gave a very thorough description of the demographics and the geographics and all that stuff. This is a Latin American airline that just has very interesting characteristics. So I'm looking at this relatively high return forecast of 16% and a quality rating certainly in the excellent range based on the stability of the company. The other thing I really like here is in order to achieve those returns, it only has to bring home a PE in low double digits. Not exactly having to stretch too much. The reason it comes up, at least one of the reasons, is Cuba. The recent stuff in the news, I think there are probably some investment opportunities. Some of them are already quite frothy, so you want to be careful in here. but Copa is one that was mentioned as a Panamanian airline that may benefit. I mean, I believe they already have assets in Cuba, can expand them. But you see some other companies mentioned. Another one that could be quite interesting to take a look at, I didn't before tonight, but I am going to take a look at it, is Maztec. Again, a construction company that might benefit from things that are going to be needed in Cuba thanks to the changing situation, which, again, could change overnight. But I happen to think that we're probably going to, in some way, shape, or fashion, stick with a cooling off of the Cuba deal. Here's a quick look at the company. I think it speaks for itself. Sales are at the top. You're basically just looking at a long-term trajectory. Seems to be doing pretty well. Earnings at the bottom here also fairly well. You can see the stock price follows earnings. We talk about the profitability of the company. You can see that a net margin somewhere in that 15% range seems to make sense. One of the reasons that I'm very comfortable with the PE down around 10 or 11 is this picture right here. It's historically been in that 10-ish range, but certainly is not a stranger to 11, 12, 13 for a PE. Value Line thinks it could be as high as 16 3 to 5 years out. So those are all fairly compelling notions. And again, just kind of doubling down on what Ken had to say a few months ago with Cuba as an additional catalyst. It's up a few percent from when Ken picked it. Here's a look at some of the assumptions that are involved here. A sales growth in the 11% range. Projected net margin, again, very close to historical levels in that 15, 16, 17% range. And again, a PE and the analysts seem to be at a slightly higher. You saw Value Line at 16. Even if it comes in at 11, which I think would be more likely, it's certainly easier, certainly more achievable, more feasible. Under those conditions, we're still looking at a company with upper double-digit, upper teens projected returns. So I'm going to suggest that we add Copa Holdings to the portfolio. Here's a quick look at the trends over the last several years. It's in a bit of a doldrum right now. It's actually down 34% year over year. I think that's a good thing, kind of in the same mode as Hugh McManus, looking for companies that are more on sale. Very, very high quality characteristics, down in the doldrums, but with a catalyst that can certainly help the company going forward. Again, it's been as high as 150 fairly recently, down around 100. I believe it was down around 90 when Ken selected it a few months ago, so we've already seen some benefit. So I'm going to add Copa Holdings, ticker symbol CPA, to the doubling down on Ken's recommendation from a few months ago. Let's go ahead and go back to our tried and true and favorite old friend, Cognizant Technology and Silence, to take us home.
All right, thank you, Mark. And I'll be quick in particular with the company itself, since we have mentioned it so many times on the round table, and it's a very well-known and popular stock among the manifest and better investing communities. Cognizant Technology is an IT consulting company. You see good consistent sales and earnings growth here, and you see pretty consistent profit margins as well. A little bit of a dip since 2005. 2004 is shown on the chart, but notice over the last 5 or 6 years and out into the projection of 2018 pretty steady, and some decline in the PE ratio, but again stabilizing. Next slide. I originally found Cognizant by just doing the stock search that I usually do when I'm looking for a stock, either for the round table or to purchase for my own portfolio or for any other purpose. You see right at the bottom of the sweet spot, 11%, quality of excellent at 80, and the financial strength of 70, and Cognizant came in very near the top, as you can see here. I was also leaning pretty hard toward Google, but Ken kind of took that one away from me, and then when I started poking Cognizant, since this is supposed to be our best buy opportunity right now, I think you'll see why I decided that it's the best potential buy right now. Manifest is showing it at a 20% par. Here is my gift under the tree that I want to toss out to you. It has been mentioned off and on, sometimes by me, sometimes by other people, on the round table that Manifest gives you the ability to do a quick industry study by clicking on the eagle. I've circled the software consulting industry, and you can see the top of the chart that pops up, and we're going to walk through this. Manifest has expanded the industry page quite a bit over the last few months, and you can do a pretty extensive industry study, and I think you'll agree with me that Cognizant is a very good, high quality, and very attractive potential buy right now. You see it's got the second highest par in the industry. Next slide. Jumping over to quality, it's the highest quality company in the industry. We certainly like to buy best of breed companies, and Cognizant qualifies. You also see Infosys, another roundtable holding. Next slide. We jump over to earnings stability. Ken talked a little bit about what he and his clubs like to do there. Again, you can't get much more stable than 96th percentile. Again, top of the software consulting industry. Next slide. Of the subcategories of quality, one of my favorites, particularly now with the stock market being somewhat on the high side, selling at historical highs and the like, is financial strength. Again, you see Cognizant's got the strongest financial strength in the industry and is very high at 94 percentile. Next slide. And then we jump over for growth, which is both a quality and potential return characteristic, and you see that Cognizant is very high in the industry on growth as well. And hopefully Ken likes this pick as I'm trying to help boost that bottom line for the roundtable portfolio from the 10.7 a little bit. All right, let's move on. Here is the top of the default eagle on Manifest, but what I wanted to highlight was the bottom part, which is the quality. Just a slightly different way of looking at what we've been looking at over the previous slides. You see, again, financial strength very close to the maximum of 25 points that it can get. Earnings stability, again, close to the max. Relative to the rest of the industry, sales growth rate, you see, is at the maximum of 25. And then, again, it's well above average for the industry net profit. Just as a kind of bonus gift, if you will, if you're looking for above industry averages, any of those columns, anytime you're above 12.5, you're above the industry average. So that kind of gives you a little bit of an idea. And again, that then equates to the 89.6, a very strong quality rating. Next slide. And we'll close out with my judgments on Cognizant. I use a 20% growth rate, which is in line with the consensus from Manifest. It's a little above Morningstar. They're in the high teens, but again, in the range of the 20%. Net margin is about flat to where it is now, and you saw the trends on the initial slide as well. And then PE ratio forecast, again, I'm taking a little bit lower PE than the current PE right now, although the 23.6 that is current is not an outrageous PE for a company with these growth characteristics, but I'm taking a little bit lower based on the historical. I believe that's actually kind of an adjusted 6-year or so median, if I recall, is roughly where that came from. And all of those judgments taken together give me a projected annual return of 16.6, a little below the Manifest 20% based on the consensus judgments, but still a very strong, solid return. I would just mention one more thing about Cognizant in closing from a valuation perspective. This is a stock that Hugh would probably hate because it is selling at or very near the 52-week high for Cognizant. Cognizant is a very volatile stock. Cognizant has run up fairly well over the last year. It's returned about 7-8%, actually slightly under the market for 2014, but it was a little pricey at the beginning of the year. What I point out, even though it's selling at a 52-week high, it has a very strong potential return going forward. As you see, based on my judgments, almost 17%. So it's attractive, but realize because of the volatility, you may well buy it today, and you may well, in the near term, see the stock price pull back a little bit. But again, over the long haul, I think the long-term holding will hold. This year, the stock has sold as low as $40 or so a share. It's now nearing 60. Let's see, 53 now. 93, and it's been as high as about 55 or so. So again, you can see that it's volatile, and the key is take, again, Hugh's perspective, even though he likes to buy at the 52-week low or 5-year low for small companies. But again, take the perspective that you're buying this for the 5 or 10-year haul, not for the 5 or 10-minute haul. And I suggest that we add more Cognizant.
Well, thanks. That'll make it an 11-time selection, and it's certainly been a stock that's rewarded many of the investors in this community for quite some time. So, Ken, I think we're ready for a poll. We're running a little bit longer this month, but hopefully we had some gifts tonight that are actionable and worth it. I think.
Okay. Okay, Mark, I'm going to launch the poll, and folks, would you vote on which one of these 5 you'd like to add, excuse me, as an audience holding to the roundtable portfolio? I'm going to give you another maybe 10 seconds here.
Do I get to vote, being at Christmas, or am I still?
No, Mark.
I'm still blocked out.
You can't vote, Mark. No, you still can't.
That's wrong.
Yeah, it is, but you can't.
And for those of you rushing after Ken, I've drubbed him for the last year, so more on that in a couple of months.
Yeah, I have to put up with it every 5 years, right? Going to give folks just about 3 more seconds here. We have 90% of our people voting. I'm going to close the poll and share the results. So it looks like we'll be adding Google twice, 2 holdings in Google to the portfolio.
And Liberty got an interesting number of votes.
Almost a quarter of our folks like Liberty a lot, too.
That's pretty cool.
I'm going up.
Good. It really is a neat perspective on management.
I will just mention, Kim very briefly mentioned that Liberty, not Liberty Broadband, but Liberty Media owns the Atlanta Braves. The reason that Liberty Media owns Atlanta Braves are the tax reasons that Kim was mentioning so much. It was part of a selling of Time Warner shares that Liberty Media had invested in.
Yeah, if it's anything to avoid taxes, I'm finding out Mr. Malloy is excellent at it.
Yeah, it was a tax play.
All right, so we'll go ahead and add...
Gives a whole new perspective to the land of the free and the home of the Braves.
And the avoidance of taxes.
Mark, if you want to close this down, and then we'll stick around. We do have a fair amount of questions, although a lot of them revolve around one answer. So,
all right.
Want to close this down?
Let's go ahead and officially wish everybody a Happy New Year. Certainly a Merry Christmas in retrospective, but a Happy New Year, and let's all have a very prosperous New Year. And again, I'll just extend special thank you to Kim from Evansville and Hugh from Pasadena. He's going to get out there and work on those floats now for the Rose Parade, and Cy Lynch for taking time out from his extremely busy schedule these days to share some time with us. And, of course, you also can.
No problem. I enjoy doing this, and I greatly appreciate all you folks helping out and all you